Selling UK property? You need to understand a significant tax, capital gains tax. The tax-free amount you can make has been slashed to a tiny £3,000. Even worse, you have just 60 days from the moment of sale to report and pay. Missing that strict deadline means you face automatic penalties from HMRC. We'll now show you how CGT is calculated, common traps, and ways to cut your bill. First, let's clarify the gain. It's the sale price minus the purchase price and specific allowable costs. Your taxable gain is then hit with high rates, 18% for basic rate, and a steep 24% for higher rate taxpayers. The best way to lower your tax is to maximize your allowable costs. But what can you actually deduct? Deduct buying costs like stamp duty, selling costs like agent fees, and major capital improvements like an extension. But you cannot deduct mortgage interest, routine maintenance, or decorating. Your own DIY labor is worth nothing. Landlord trap. Taking out equity via remortgaging does not reduce your gain. It's based on the original purchase price. You've calculated your gain. Can you eliminate it? Tax reliefs are the answer, but the rules have tightened. The most powerful is principal private residence relief. If it was always your main home, the gain is usually tax-free. The rules offer some grace. The final 9 months of ownership are always exempt, even if you've moved out. Lettings relief used to be a major benefit, but is now almost gone. It only applies if you live there with your tenant. Inherited property? No CGT is due on inheritance. Your cost base becomes the market value at the date of death. Spouses have a unique rule. You can transfer property between you with no gain, no loss, a key planning tool. Now, for real-world scenarios that create unexpected tax bills, even when no money changes hands. Gifting a property to your child is treated by HMRC as a sale at full market value, creating a tax bill with no cash. Contrast this with the spousal rule. Gifting to a spouse is tax-free, but to a child can create a huge liability. Non-UK residents are also liable for CGT on disposals of all UK property, both residential and commercial. The rules get more intricate, which creates opportunities for smart planning. Let's look at some advanced ideas. Have losses from other assets like shares? You can use those capital losses to offset your property gain and lower your tax. A smart move involves pensions. Upping contributions can extend your basic rate band, pushing more gain into the lower 18% rate. Thinking of moving abroad to sell? If you return to the UK within 5 years, the tax on that gain becomes due. Let's connect these different ideas. How can a married couple combine these rules for maximum benefit? We asked how to legally reduce the gain. For couples, the method involves combining 3 points we've covered. First, use the no gain/no loss spousal transfer. This allows you to use two £3,000 allowances, shielding £6,000 of the gain. Second, this splits the gain. If one partner is a basic rate taxpayer, part of the gain is now taxed at their lower 18% rate. Finally, add the pension move. The basic rate spouse could make a pension payment to keep even more of the gain taxed at 18%. Knowing these factors is what determines your final CGT bill. Let's review the absolute must-knows. 1. Your tax-free allowance is only £3,000. 2. You have just 60 days from completion to report and pay. Do not delay. 3. Keep perfect records of all costs and improvements. No proof means no deduction. 4. Your main home is not always fully exempt. The system is difficult, and penalties for mistakes are high. Gifting can trigger tax, and non-residents are not exempt. The most valuable action is getting professional advice before you act. Planning ahead is the only way to pay the correct tax